Okay, so I'll just do a quick sound check. It should be fine now, but it was stuck before. Let me just see if I can check, get that volume correctly now. It's on your screens. Just let me know if it's perfectly loud or too low. If it's too loud, you want to just adjust your settings. Everyone else is saying perfect. You want to just turn it down a little bit. Okay, that's great, guys. Thank you very much. Okay, well, an interesting, I guess, session on Friday for the non-farm payroll. Yeah, it just goes to show that even people that have done this stuff for as long as me, have to take a losing trade on the chin. So yeah, I took a fairly not a massive loss, to be honest. 1,600 quid was what I lost. I was a little bit more offside than that at one point in the trade. But you can only do certain things, and it's funny how people react, and it's funny how people talk about the event, and people say, well, it wasn't a particularly good trade, and yada yada yada. Well, I'm not really interested if you think it's a good trade or not. That's first and foremost, because I do know more than most people out there. I've traded about, I don't know, 400, 500 non-farm payrolls. They're all different. Okay, they're all completely different. So there's no way of getting around that if you get a non-farm payroll wrong, then you're going to lose money. Now, the reason why I lost money and didn't lose as much money as I thought, because I stayed with my conviction and got out on a green candle. I'll go through the trade in a minute and show you why I didn't lose as much money as people out there. Then I'll go through the ideas of why I did lose money. Now, I lost money, so in the eyes of everything equal, it is a bad trade because nobody likes to lose money. But I lost money doing what I believe was the right thing. Okay, and I can only go off what I know as an experienced trader and somebody who's traded so many fundamental pieces of information. I can only go with what I know. Okay, obviously with the perfect of hindsight and listening to all these expert commentators lately, it's like, well, of course the market was overbought. I'm going to sell off on a good non-farm payroll. So no one's worried about interest rates. I've been talking about interest rates for 18 months. Okay, I've been talking about interest rates before the Fed were even knew they were going to talk about interest rates. None of these things are a flash up to me. But when you're trading intraday, you're trading non-farm payrolls, you're trading quick-moving, fluid markets. Especially when you're trading £54 a point as I was. These things, are a little bit hairy, and you do have the ability to lose large sums of money, which £1,600 was really less than 1 week's money that I've made. So it's all relative, it's all relevant. Now the whole point why I teach you different ways to learn and different ways to trade is I'm not telling you to trade like me. Okay, I'm not interested in you trading like me. Yeah, I'm not here to be a trading teacher, as in I will give you my strategy, follow me, and you'll make money. Okay, what's more powerful is me teaching you a way to learn your own strategy, be self-fulfilling, and trade. Okay, as I say, these are educational only, these webinars. There's not many people out there that trade their own account and trade live. And again, I generally always make money. 46 non-farm payrolls, that's only the third time I've ever lost. Okay, made much more, okay, than I've lost in total. And these losers are just part of trading. If I didn't lose, then I wouldn't be human. I wouldn't be a normal trader. These things just happen. And I'll go through the trade and let you understand my thinking, my logic, and then we'll move on, because the non-farm payroll is gone now. Okay, that was just one trade on that Friday. Okay, it's very exciting. We have a lot of movement, but at the end of the day, it was just another trade. I'll get my money back, I'll crack on, and I'll show you what my targets are for the coming weeks, and how we're going to get on board with all that. So let's do the risk warning before I start and share the screens with you. Spread betting and CFD trading carry highly risk or capital and resulting losses to the each initial deposit. The most suitable for everyone, so please ensure you fully understand the risks involved. The information provided here in no circumstances consider an offer to invest. Nothing includes investment advice. The information provided please be accurate to the date it is produced. Education only. Content of the webinar is posted over the moderator on Insurer.com. The content is not constitute financial investment or tax advice. Insurer.com has not set any liability of the content of comments made during this session. So I'm going to share my screen to you now, very much like the NFP, and we'll just go through. We'll go through the NFP and the S&P right now, and just try and get a bit of a handle of what exactly happened. So you'll be able to see my screens in just a second. Okay, they should be up now. So what I'm going to do is I'm going to bring the NFP screen up here. So first of all, this is the Fibonacci that we drew on the 50-minute candle. We're on the hourlies right now. But as you can see, I mean, it doesn't take a genius to know where that NFP came in. It came in here, and again, we sold off very, very aggressively. And Ian brought up a question a little bit earlier on: is where's the best point to get out? Where should I get out? Where should I admit I'm wrong? And I'll show you, the exact point of where I realised I was wrong, and that was fairly early on into the trade. But I'll just get into the 15-minute charts. We'll just see a little bit better. So really, what happened is the non-farm payrolls came out here. Yeah, and we started to, we went up originally, you know, because I bought some S&P, I bought some FTSE, and we went up originally, you know, for, you know, a good few seconds. Then all of a sudden, you know, it started to look bad, but then the market closed back down, made that, you know, double high, and then did nothing but sell off. So realistically, I realised I was wrong in this trade when we kind of, you know, heavily broke through 2,000, 2,100, okay? So that's when you know that you're in trouble in a trade. Now, by this point, I kind of averaged into the trade to about 12, 14 lots at this point, and I was about, you know, £300-400 offside. You know, it's hard to recall exactly the amounts, but you know, get to a point where you think, right, well, I'm in this trade now. I'm trading the non-farm payroll. The figure was expected 235,000, coming out 295,000. Okay, we're in a massive bull market. No matter what the market might want to do, at some point we're going to have to see some profit taking, and any, you know, major indices is going to have a bounce. Now we'll go into all the other markets that I called completely right to the tick. You know, that's by the by. You know, I traded the S&P for a couple of reasons. Now, the first reason why I traded the S&P is because I got the figure a little bit before most people. You'll see that I said the figure well before it appeared on some of the news wires. So again, you try and take that instant split decision, that judgment call to think, right, okay, well, the market's expecting 235,000. We're at 293. That's like the fourth consecutive non-farm payroll we've seen above expected, ranges. We're outside the Bloomberg range. No matter, you know, what anybody says, I can only do the right thing. I can only buy, you know, a heavily bullish market on the back of such an unexpected bullish non-farm payroll. So that's what I did. Now, I'm just writing some new courses for MetaTrader right now about the art of trading. And, you know, sometimes, you know, early on in the trade, when the market's going against you, not doing what you think it should do, then it's best just to get out. But it also, it's that fine line between doing what you know is right and then being able to then get massage your trade and use your ability to average, use your ability to size, to not take on a loss or to take enough pain on board in order to make some money. So as the market started to break down from these low points, we got below the 15-minute Fibonacci that we drew. So I knew that realistically my pain point was down to here. Okay, so 2092.80. So realistically at this point in the market, we were generally buying from here, we bought some here, so we're trading quite heavily down. We're at 80 ticks, pretty much averaged in offside. So by this point, I was about £2,000 offside. Okay, so not great at all. Probably a little bit more than that. And then the market quickly blipped back down to here. Now, the big thing I'll say about here is that yes, okay, I will teach 99% of people out there to say, right, well, if you're at this point in the market, you know, has gone down and hasn't looked like coming back, then just get out of the trade, you know, live to fight another day. But as I said, with, you know, the amount of money I've made over the last kind of couple of weeks alone and the amount of experience I've got in the markets, there was absolutely no way I was getting out of this point because of the fact we'd seen 1, 2, 3, 4, 5 red candles. Okay, so we've seen 5 15-minute red candles. So you just do a quick cycle back through the charts to see the last time you saw 5 15-minute red candles. There isn't. Okay, you have to go back to something ridiculous. You know, not even here when we saw this down move here. You just don't see 5 red candles, especially not after a non-farm payroll that's significantly higher than the market was expecting. So I said, right, the fact of the matter is I'm 80 ticks offside, so it doesn't really matter what happens from this point. I'm going to let the market, you know, go back as far as it wants at this point because I'm almost like poker. I'm all in. There's no way I'm getting out of this trade until it at least comes back to a level that I think is some value, or I see a green candle. So what happens is I take this extra pain on board. So I think, you know, at one point it's probably £3,500 offside, and it's like, again, well, it's closed a red candle. You know, again, I'm not getting out until I see that green candle. So the market then again opens up higher than this next 15 minutes. Had to wait a substantial amount of time, you know, after the non-farm payroll to see this green candle, and then we see 2. So I was able to get some out of here, buy a little bit more, average into here, and I got out just as this candle came back down to here. So all in all, I took about just under a £1,600 hit on the S&P. So I got out here. So as Ian was saying, you know, what I was willing to do is I was willing to take on this point here. I was willing to take another 55 ticks of pain on to be able to get out, to get them extra 20 ticks. So it doesn't matter that that's not by the textbook trading. Instead of getting out of this trade for an offside total loss of what probably would have been about £3,500, I've got out for a loss of £1,600, which is still a lot. It's much more than I tend to lose on any data trade or any intraday trade, to be honest. But it's unusual circumstances. You've seen the figure come out, you've seen the non-farm payroll come out much stronger than expected. You're in a massively bullish market. The market sold off down to here, and you think, great, that's enough to squeeze all the retail traders out. We don't really have to go much further than this. Then bounce back up, get back to the range, we average in, everyone's made some money, and it's happy days. But the market didn't want that. It wanted to go much further, much aggressively down. Then after the event, there was quite a lot of kind of market chatter that a lot of the big banks were short. And as I say, there's nothing you can do. If the banks are short, the institutions are short, I can't take on the banks. Okay, I can't take on the institutions. But what I can do is say, right, well, I'm not getting out till I see what I know is value, and I see a green candle. So after the 1, 2, 3, 4, 5, this is where you have to take the most pain, the 6th. But then after that, you get the 2 green candles, 7th and 8th, and you get, any kind of area of value out. And I knew I was taking a loss. As I said, I knew at this point when we've broken below, but when the market moves so fast, you just have to take that short-term pain on board, knowing that you have to see a green candle, you have to see profit taking, you have to see that reversal, and I choose to get out here. So again, instead of taking a massive loss, I just took a big loss. Okay, but the massive loss would have been substantial. The big loss was just a big loss. And again, as I say, I have more than the ability to make £1,000 in a trade. So losing £1,600 is not the worst day trading I've ever done in my life. That is, without a shadow of a doubt. But again, it's about sticking to the rules, sticking to what you know. I was never going to sell into the S&P coming down because you just expect, with the markets being so bullish and being burnt by trying to sell every high in the DAX, every high in the indices, that this is one of these. You're going to see the market sell off, which you half expect on a non-farm payroll. The market to do the exact opposite of what you think, and then the market comes back and bounces. So, you have to take that judgment call, and as I said, I was fairly sure I was taking a loss. It was just what size of loss I was taking. So I didn't take the biggest loss I could. I certainly got out, I think, really, the good area, because as you see from here, the market comes back and really does hover around the area I got out. After that, if it had stayed long, the market goes off and drops significantly. So if it had not got out, we'd have had to take on another 144 ticks of risk, and then it pretty much would have been almost close to an account wiping out trade. And I've got plenty of money in my account, and that would have been disastrous. So knowing when you're wrong is really, was at this point, Ian, your point was spot on. After 45 minutes into non-farm payroll, I was wrong, but I was not going to take, I was not going to take that loss on board until I'd give the market every opportunity to bounce. Because, nine times out of 10, you see the market do this, reject, and then you see 2 green candles that get back to the 50%. And I said this level here, this 210.01 spot 11 was a good point. And if we got anywhere near that, we'd have made, a massive amount of money. We made probably about £4,000-5,000 on the trade. But as I said, the problem with averaging in, the problem with trying to wait for that bounce is when the markets don't do what you expect, you've got to take a huge amount of pain on. So we did take a huge amount of pain on, but I think I still got out a relatively reasonable level. And if I hadn't got out of here, I'd have to take a lot more risk on and probably got out here or here and probably taken that £3,500 trade. As I said, I'll always be honest. If I just turn up and do non-farm payroll to do nothing but make money, then you'll think to yourself, well, why are you not trading, £1 million hedge fund, Steve? Why don't you take all the offers you've had? Why are you just trading these non-farm payrolls live? I like trading non-farm payrolls live. I don't like working for other people. Okay, I like working for myself. I like presenting. I like building up a following. That's what I enjoy. Okay, I don't like making rich people richer. I like making myself richer. So that's why I don't do these kind of things. And as I said, this is a loss I took on board. It could have been worse. And there we go. I'm going to say no more about that. That is just exactly one of these things in trading. You can do the right thing, 9 times out of 10, and then the one time you don't, you get it wrong. Now, the other things I did predict was the high in the DAX. Okay, so I could have bought the DAX, and the DAX did go on to make a new high before it sold off. And also gold was the absolute turning point from here. I said that gold was likely to get a massive sell-off, and I said it was going to get down to these low levels here where we're trading right now. This level of 1170 spot 40, and we did. So I could have just shut my eyes, sold gold, and made 270 ticks. But the reason why I didn't actually short gold and I bought the S&P was back to almost falling into old habits, because what I'd seen is at the corner of my eye before I'd seen that 293 non-farm payroll. I'd seen gold spike down to these low levels, so I thought, well, I'll just get into the S&P as soon as I can when I heard the figure, because that will just allow the S&P to spike up and get to the other levels. And then if gold does drag down, which I knew its ultimate targets were down here, then that would push the indices up, because obviously I believe that gold's in a very bearish pattern. When we'll go through gold in a minute, and the gold goes down, you've got a good inverse correlation. The S&P will go up. So I was really trying to steal a march. It would have been a bit more, again, because we'd had to wait for the delayed figure and it was a bit more jittery. Again, it was just you were looking for that quick value. So I turned a quick scalp into a long position trade, which I always advise is a bad thing to do. And again, sometimes, you just have to roll with it. You have to go with what you've done and take the consequences on board. You don't get any chances, back in trading. Everyone looks at the charts now and go, well, Steve, you were silly to buy the S&P. You could have just sold gold, couldn't you, and bought the DAX, like you said before. Yeah, but I didn't. So what I did is I bought the S&P because, again, I was looking for that value based upon gold coming down and getting the figure quite early, and it came down. But, quite easily we could have seen this doji here. The market rejected. We've gone up and we've closed up 80, 100 points and made record highs in the S&P. And I've made 5,000 quid. No one thinks to say, oh, that's an amazing trade, Steve, aren't you amazing? These things you got to just kind of take us out. There's no takebacks in trading. There's no gimmies. And that's always what I try and do with these live data trades, is put my neck on the line, put my head on the chopping block. And when I win, I win. When I lose, it is part of trading, okay? And these are lessons that cost me money. They don't cost you any money, okay? They cost me money, okay? So I have to bring you the honest way of trading. So let me just, is any other questions coming through? I know Ian's trying to say something. So don't know if you noticed, but the market did just about the 50% before the move to the bottom of the spike. Do you think continuing to average at the bottom of the spike was taking too much risk? Okay, Ian, yeah, obviously very good questions. Yeah, we did nearly get back to the 50%. You're exactly right. And again, with all things perfect in hindsight, yeah, I should have got out of the trade there, and I wouldn't have taken on that much of risk. I probably would have lost about £600-700. So lost half of what I did. And do you think averaging at the bottom was taking on more risk? I'll just show you for the final time. Okay, I've been a trader for 14 years. Okay, and when I look back in the charts and don't see ever, 5 in a row of 15-minute candles, I know that the majority of people are taking the most amount of pain here. So I know where my levels are. My levels are good. So I know that once we get to this low point here, there's no chance of it bouncing. Okay, there's no chance of it bouncing significantly. It's going to get smashed. So I know this. So at this point here, I'm just thinking to myself, well, 5 red candles. So I've got to either press the button at this point to get out, which is quite a good loss here, or I wait for the green candle. So what I did is I liquidated my FTSE position. I waited for the market to come down here, and as it hit these low points, do you know what? I took a little bit of a leap of faith. We've got down to these low points here because I had no other levels to go on. I just bought back into the low points down here, and that's really what kind of got me back, because I got out. The market came back up to here, so I liquidated some. Then as it kind of dropped down a little bit, I bought some more, and then got out here. So it was kind of 2 very quick decisions to kind of liquidate some positions, to buy some more here, to get some of that loss out here, to then buy some more, to then get it out here and get out. Now these those decisions in that probably space of 3 or 4 minutes when I'd waited for the best part of an hour were the ones that again stopped me from losing another £3,000 on that trade. And yes, it probably was too much risk to take on at that point, Ian. But sometimes when you're in these very, very extreme circumstances, and remember, I'm not trading blind. I'm not an idiot. I'm not somebody who has no experience in trading. I write software packages. I know about technical trading, and I've traded hundreds of non-farm payrolls. So I knew that at some point you were going to see a green candle, because that's just trading. That is just 14 years of experience. So I was waiting, anticipating that green candle. So I knew that everyone was like me. They were like, well, after that 5th candle, we're not going to have to see a red one, and that'll probably bounce here and go up here. Happy days. Everyone's probably made the money back that's averaged. But it didn't. We went back down, had to make 2 quick decisions, and there we go. So yes, long and short, Ian, I did take too much risk on that trade, and I did pay the price as in my ultimate loss, but didn't lose as much as I could have done. Now, If that's right or wrong, I don't know. As a professional trader, professional risk manager, I did what I thought was right at the time. And I know I can make £1,600 back. And as a percentage of my account and the amount of money I'd won over the last 6 weeks, I was willing to take that risk on. I was not willing to get out of the bottom and kick myself all day long for taking the loss down here. Yeah? Call it stubborn, call it whatever you want. Okay? But sometimes you just have to stick to what you know is right. That was a good non-farm payroll figure, one of the best we've seen in a long time, so I had to buy the dips all the way down in the stock market before I saw a green candle. All right, so I don't want to bore you anymore with that trade, but I thought I had to just kind of go through and just make people understand why these things happen. And I got out intraday. I didn't hold it overnight and be greedy, because if I did, I would have got destroyed. So again, it's another lesson learned. So let's go back to gold. Gold's really what I've been looking at for the last 6 months, and if anybody's listened to my presentations for any amount of time will know that I'm very bearish gold. Let me just go back to absolute basics and show you why, technically, and a couple of fundamentals why we're moving down in gold. Firstly is the technical reasons. As you know, I say that markets move 80% of the time in a technical manner, okay? Because that is the most things that happen in the market. People can figure out Bollinger's, Fibonacci, RSI, etc., etc. So 80% of the time, a strong directional move like this, where we trace to 50%, it does. Okay, so we get back, in pretty much January 2013. We then go lower, we go higher. But from a technical perspective, yeah, lower high rejections, lower high rejections, lower high rejections, lower high on that 50%, pretty much to the point, and rejection. So what we're looking to do is break this lower Fibonacci, as I've been saying for months and months and months now, let the market come down, and it's got this huge void to hit. Where do you think gold is going to get to after 1,170? Hands up, any ideas, any thoughts? I know, because I said it in the Financial Times in 2013, I said, by 2015 we get to $1,000. It's going to get to $1,000 because there's nowhere else for it to go. Okay, as we start to use these Fibonacci's, once we use this as resistance, okay, then this is support resistance. And we saw how it acted. Look how the markets are trading beautifully technically. Yeah, this is a real option for the market to bounce higher here and go on to break this level as 50% and make new highs and get back to 1900. Okay, if you think the fundamentals that are driving the market, remember gold is anything to do with fear. People buy gold as a story against inflation. Well, what is inflation? What is inflation? Everything's rising above the price of inflation. We don't know. The ECB, the Bank of England, and the Fed do not know what inflation should be because they've messed around with interest rates for so long, they have no idea what inflation should really be. All we know is wage prices aren't keeping up with inflation. We've had a bit of relief, as in the oil prices have got literally tanked over the last 8 months, but that's not really making us any richer. That just means we don't get as much pain when we put petrol in our car. It's not a true cost of living. So what we're seeing from a technical perspective is that every time gold looked to make a serious recovery back to significant levels like 1300, 1400, 1600, it rejected. So now we're trading pretty much purely technically. And once we break these lows in gold, I tell you, it will be a matter of maybe weeks before we hit $1,000. Okay, this market is looking very, very weak, and this Fibonacci scenario is how it works. So we've just gone from the low to the high. And that's as basic as I can make any technical analysis. But watch how you filter through the charts to the weeklies. Starts to look nice again, doesn't it? What do? You don't do anything too flash, anything too fancy. Get yourself a nice looking trend line. Okay, and again, these things don't always have to look perfect. That's your weeklies. So every time we get high, sure, we're coming down. We broke through it here. But again, we've hit that key 50% fib, which outrules this trend line 100% daily. Okay, market again shows us weakness. One final push up, then 1, 2, 3, 4, 5, 6, 7, 8 selling days before we see this big spike down. Where does it get to? That trend line. It's not a coincidence, is it? So now we've made this nice, selling day after that positive non-farm payroll. So positive non-farm payroll, better than expected. That's right. Gold sells off. What does the S&P not do? That's right, sell off. So you can see why people get confused. Okay, indices go up on good data. Gold goes down. So gold did what it needed to do. The euro did what it needed to do. The pound did what it needed to do. But the market we were trading didn't. That's trading. I'm not going to sit here crying about it. It's not a big deal. These things happen. I got to trade wrong. I picked the wrong market. And everyone that listened to my non-farm payroll, You know that I picked the high in the DAX. You know, I told you where gold was going. But once you're in a trade, you're committed to it, you've got to see it through. That's trading. You know, that is trading, I'm afraid. So gold now, we're kind of hesitating. Again, if you want to just do yourself some simple, charting, do your Fibonacci again. So in your daily, where's that 50%? So as long as gold doesn't get back above 1181 spot 98, gold's going to make new lows. Okay, and your new lows are here. You know where they are. Okay, so you've got some nice bonus Fibonacci expansion points we can get to before that $1,000, but they're all pretty key, aren't they? Okay, 1141 sounds nice. You can hear market commentators and squawk saying, well, gold's dropped through the new lows. We're hitting that key technical level of 1141. Next target, according to Steve Ruffley and Bloomberg, is 1104, and then below that, there's nothing. Nothing. Your $1,000. You know, maybe you could put in your token 423 spot 6. 1044. But realistically, once we've broken $1,100, there's only $1,000 that people are aiming up. Big round numbers. You think about, back to this monthly chart, how many people are long gold. If you're long gold from here, you're out. If you're an institution, you're long gold from here, you're out. Because you know that $1,000 is a major target. So these are the things I look at. These are my trading targets, aren't they? Okay? So it's all about what you think is going to move and where you think the money is. Now, obviously, non-farm payroll was a little bit of a tricky one because you're trading. I was pretty much live trading. 8 potential markets and looking to go off the back of that headline figure. The majority of markets, as we saw, the euro was weak. The dollar got strong. It was only the indices. They didn't really play ball. And as I say, that's well without my control. What's in my control is making them judgment calls of how much size I put into the markets and how long I hold trades for. So yes, there's every opportunity. If I put my hands up, said I probably had too much size on, I probably averaged in too early, and it was probably too much of an aggressive trade. Okay, I'm not going to apologise for being an aggressive trader, and I'm not going to apologise for losing my own money. Okay, what again I will say is that these things happen in trading, and I got out. I didn't think I got out for a win. I just got out and I knew I didn't get out on the low. And that's sometimes all I need to justify a bad trade, because it wasn't a great trade. But I can justify that I didn't take a pounding. Okay, I can take a £1,600 hit on my account. And if you can get into that mindset, and when you have a bad trade, or you put too much size on, you get caught out, if you can come back with that kind of justification you did the right thing, then the next time you have a good trade, you're going to feel different. The next time you have a series of good trades, you're going to feel different. When you have a bad trade, you're actually going to feel different. Because if you can justify what you've done and still thought, well, do you know what, I gave him my best shot and I gave myself every opportunity, then I'm happy with that. I'm happy enough with that. Because, up until that point, I'd made about £7,000 in the space of 6 weeks, just intraday trading. So non-farm payroll is a difficult one where you've got £54 a point on. It's either going to be a great Friday and you're drinking, Dom Perignon, or it's a terrible Friday and you're drinking Dom Perignon. And I was drinking Dom Perignon. Okay, this is trading. If you can't take a loss on board, you're in the wrong game. Go and do something else. So gold, for me, really, we're building up this this nice formation. So again, look for this low level to be hit once again in gold. So what you need to do as well is understand is that everybody now knows what Steve Ruffley's been talking about. So when I was saying that gold's going to hit $1,000, I had people said I was an absolute moron. So I was an idiot. Said gold's going to be trading close to more to $5,000 than it is $1,000 by 2015. Well, that's the reason why I've been quoted in the non-farm in the Wall Street Journal, Bloomberg, Reuters, because I understand markets and I understand how things trade technically. The big fundamental driver why gold isn't going up anymore is because if there was enough fear with Russia, the global slowdown, blah, 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 with whatever the experts tell us, gold would have made the effort to get back now. Gold has told us by that 50% level here on the monthly that it doesn't want to go up anymore. There's a rumour Fort Knox is empty. The Bank of England sold the majority of gold at the low. So who's buying this gold? China? India? Yeah? Tehran? Iran? Who cares? Yeah? The world markets don't care. Why do you think the reason why oil got smashed? Okay? It's absolutely nothing to do with fracking. Nothing to do with fracking. It's absolutely nothing to do with global demand or global supply, right? It's just a political game. Okay, we couldn't really stop Putin from doing what he wanted to do in the Ukraine because he's got nukes, and we've got nukes, and we're a little bit frightened of Putin with right reasons, because he's a lunatic. So what we did is we took him off at the knees. Yeah, you don't see the ripple throughs just yet because all the media's controlled it in Russia, but they're having a tough time. Okay, I have Russian, billionaire clients, and I know the difference between what people know and what other people don't know. Okay, people are running scared, so this is going to hit Russia for a decade, generations. So the ripples are just coming through now. So the reason why oil's been brought down is through political means. Okay, and gold is just the same. You do not want, China, India, countries that we tolerate but don't necessarily understand the trust, as in the Western markets. We don't want them with, all this valuable, tangible, untraceable assets, do we? So that's the reason also why I believe gold came down. So if you're looking for a short in gold, wait for it to spike. Okay, wait for it to test 1181 spot 98 and maybe get up a bit further. If it does it, it'll generally do it as gold does in one or two candles, get everybody out and then come down. So if you are looking to sell gold, make sure you sell it high. Be very, very wary of selling it on the breaks. So my main targets, I think now, are just to see what the indices do next. So the indices, again, we've got the Dow, record highs. We've got lots of things happening. I don't think the indices have finished buying just yet. Okay, pick the absolute high in the DAX, which was slightly irritating, and I'm still a firm believer that although we've sold off now, there's still plenty of value in the FTSE, and we're still going to get to 7,000. So really, it's about the euro getting to parity at 1.0. Okay, we'll go through that technically in a minute. But again, the other main thing I'm looking at is the pound dollar. So as I've said to you for a number of years now, these things take a long time, don't they? They just take a long time. Economic cycles are much bigger than the people think. And this is another reason why I believe that politicians and parliament should actually be in term for longer, that they have to see things through. Because every time we get, because the pace of change is happening so fast, every time we get a new government in, it's like, well, got to sort out what the old government did because they destroyed it. So we're going to bring a new plan in. And by the time we get this new plan in, they've invariably been voted out again. So we're just back to this bitching and moaning. It's like, well, they did this, so we're trying to fix this. It's like, well, you tell us what you're going to do. Then in 10 years, you better have done it. Okay, so that's what I believe we should do. And that's what you see in the markets. You see the pace of change happen so quick that it catches the policymakers off guard. Remember, we've been left with a really strange set of circumstances. 7-year low interest rates, trillions and trillions of pounds been lost by savers. And instead of, tackling interest rates earlier and having a proper correction in the housing market, getting the market stimulated by new buyers coming in, people having a better opportunity to buy on low incomes or be able to buy the first house. Instead of doing all that, we spend all this money recapitalising the banks, so then I can put in my savings account. I've got a lot, but what I've got, I think last month I made something like £1.17 interest on the amount of money. And there's thousands in there, like tens of thousands. There's £1.17 in there. It's like, how can that be the situation where I get charged by my bank a monthly fee? I get no money back relatively in interest, and then that's the way we think these things are going to solve the world. It just doesn't make any sense. So what we're looking for now is, I've told you, these cycles take years, and this might have been the last non-farm payroll, the last bit of growth figure that we truly focus on. I don't think it can get any better for the US markets next month. The next non-farm payroll, again, I'll expect it to be higher. But although it will be a massively volatile figure, I think that people, real traders and the majority of policymakers have kind of priced this in now, that the jobs are coming back into the market. They're not as good at paid jobs. They're not as safe jobs, but they're coming back into the market. So what really that means is that the Fed have to now look at the inflationary pressures and interest rates. So there's a whole series of events, news events, that we're going to have to focus on in the next kind of 2 or 3 weeks. And generally, they all relate around speeches for the Bank of England, the Fed, and the ECB. But also, more importantly, they revolve around the more inflation-type figures. Now, again, as I said, I've said this for a long time, that there comes a point where we'd stop focusing on growth figures and start to look at inflation figures. And we're nearly there. We really are, hand on heart's nearly there. Janet Yellen came out from the Fed over the last 2 or 3 weeks and has basically gone from giving us any kind of idea on forward guidance to going a complete about turn. It was, interest rates are going to stay as low to zero for a considerable amount of time. Then they dropped the word patience in the attitude to interest rates. Then Janet Yellen came out and said it's probably more likely the end of Q4 2015 or even 2016 Q1 interest rates would rise. And then all of a sudden we've got this figure of June. Now all the world, expert commentators are now coming out. All the people that say they know what they're talking about have said that interest rates are going to potentially go up in June, and that's going to have a massive ripple through. That's why we're seeing the strength in the dollar. The strength in the dollar is basically here from the non-farm payrolls, but the strength in the dollar, pretty much that we can see, all these highs being made over the weeks, is that the interest rates are more likely to go up in the US. Therefore, people are putting the money in dollars for a better return. That's another reason why gold's going down. There's a reason why we're going to have another correction in the property markets, because people are going to shift out their property and shift out the stocks, indices correction, when you can get some bang for your buck again. When you get proper interest rates, people are going to move back into cash, because people understand cash and they like it. So this is the reason why we're seeing this dollar strength, especially against the Japanese yen here. So again, going on to make these new highs at 120, really I've very little kind of real idea of how high we could get to. I know that I was interviewing FX Street 7 or 8 months ago down here saying that, we could easily get to 120, but above that I didn't really know where true value would be. But, again, it would have to be, going back previously in the charts to these highs. So maybe we get back to 128, maybe we get back to some of these other highs, we get back to 134. Anything's possible. Anything's possible. And while the market takes these fundamental drivers of interest rates, the strong growth in the US, the wobbles that we've seen in Japan, the wobbles that we've seen in China, the potential housing bubble, these emerging markets, these tiger economies, not looking quite as stable as they once were, then obviously we're going to see people shift into trusted currencies. The dollar is the world's currency. For as long as I've said sell every high in the euro, buy every low in the dollar, because the dollar is the world currency. So that's an idea of where the dollar yen could potentially go. Again, something I did get wrong was the pound versus the dollar. So if we look at the pound versus the dollar, I was 95% sure that the UK would move first of the G8 nations on interest rates. Okay, and maybe I was a little naive to believe that in the UK we'd have a government that had some balls, a government that had some sense of responsibility, and it turns out we don't. So realistically, we're seeing house prices in London back to pre-crunch levels. We're seeing record prices for number one Hyde Park going for 150 million quid or whatever stupid amount it was. We're seeing that 150 foot square house going for £250,000. These things are unsustainable. And again, my biggest thing in trading is, as I said, it's about being right in trading. It's not about being right in the right opinion. Sorry, it's about being right at the right time. So I could be right that house prices are going to crash and tumble, because they are. Okay, doesn't matter what anybody in the world says, they will. But it might not be for another year. Might be another 5 years. Might be 15 years. Might have to be in 25 years. At some point, they're going to crash. And there's simple reasons for this. First of all, is with the housing prices. If you price people out of the market, then they stop buying it. Okay, they stop having the interest to buy. We're not creating any types of new human beings. So if you've just come through the system, you've gone to university, got your £20,000 worth of debt, you're expected to raise £70,000 for your first deposit on your house, which is the average in London. Where are you going to go from 25 to 29, say, to make that £100,000 just to put down the house that's overpriced anyway? You're not. What's going to happen is when the kind of baby boomer generation starts to die, which is not too long, to be honest. My parents, early 60s, and they have a lot of property, and come 70s, 80s, they're going to start to die. It's just natural. These things happen. We're not going to have the free NHS, by then. We're not going to, unless you got huge sums of money. You're not going to be able to, just live forever on the NHS. It just won't be possible. So as that people die, I'm going to inherit huge amounts of property, which is just money, and I don't want the property, but I'll take the money, no problem. So we'll sell the houses, more supply. The economic basic principles. As the market gets flooded, and it'll happen quicker in London because property is appreciated a lot quicker and worth a lot more. And if you've seen mum and dad, work hard, get the house, make a lot of money, then retire early and go and do cruising, you're not going to keep the family home. You're going to sell it. So that's what's going to happen. But digressing a little bit, when I was saying about interest rates moving first in the UK, we were around about this level. Okay, I was thinking that we're going to see a nice hard bounce back to 164, maybe above, because sorry, I'll go to the monthly charts to be easier. Again, if you want to know how things happen, Fibonacci, high to the low. Okay, then we get an idea of value. So this big sell-off towards 2009, we don't quite get to that 50%, do we? So when we don't get to that 50%, what we do is actually start to sell down. And we know we're going to see green at some point because we see 1, 2, 3, 4, 5, 6, 7 months of selling. So it doesn't matter if you're a useless chartist. 1, 2, 3, 4, 5, 6, 7, 8, green, 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 green. So there we go. What happens? Goes down, has to go back up. Now this is where we're slightly different in the pound, because I think, just like myself, a lot of people have been caught out here, that we're expecting the market to kind of find some strength down here, bounce back up, on the strong possibility that the UK, being a fairly small, self-contained island, will be able to control its own interest rates and not let us get into this situation where people, hard-working people can't afford their own houses, elderly people can't get any returns on the savings, and just creating this bubble again. We didn't think the UK was that stupid, but however, they are. So we didn't see that bounce. And as these noises were made by the Fed that the potential market interest rates could move, then we've seen weakness. And here, where we saw that 7 months, we expect green, green and green to get back to some value levels like we saw in the past. We don't see that now because it's come out that the Fed are probably going to move on interest rates first, so that means the pound is going to go down. So what the pound's going to do, pound's going to hit these lows here, the pound's then going to hit these lows here, and then the pound's going to get down to these previous lows here. So realistically, we're going to see a drop of maybe 1,500 points in the pound now. We're going to see significant pound weakness due to the fact that we're not going to move until after the election, and probably even when the whatever party, whatever coalition gets in, knows they have to move interest rates. These people aren't idiots. They act like idiots, but they're not idiots. They know they're going to have to move on it. But it don't matter because they own the houses outright. They don't really care about interest rates. So when they know they have to move on interest rates, we will see a bounce in the pound. But instead of seeing a bounce higher up, we're going to see a bounce much further down. So I would say realistically, we don't see a bounce until 1,432 or maybe 134. Okay, so the pound, now we've kind of got the idea the Fed are going to move before the Bank of England. It's all about finding them high points in the pound to sell, and it's looking for value. So again, bounces could be seen down here and here, but we're definitely going to see weakness as long as the Fed are maintaining that they're going to move on interest rates first. So, and again, you can just look at these on the weeklies. I mean, again, you don't have to take my word from it. I mean, look how these fibs have worked. Yeah, tell me if that's good support or resistance. Yeah, tell me that market has come down and tested support and resistance. If it's done the same here, these Fibonacci's and your higher time frames are absolutely how you should trade. So your weeklies are looking negative. Again, go on your dailies. You want to see where the market's going to go. Do your Fibonacci low to the high. Yeah, as long as we don't get above the 50%, we've still got more sellers than buyers in the markets. So let the pound get up to this level at 151477. If the Fed are going to move first on interest rates, and that's what you believe, we're going down because people will dump their pounds and buy dollars. And you want to see dollar strength? There it is. That's your dollar strength. Here, consolidation, tiny consolidation to here. That dollar is as strong a market as the indices were looking a few months back. So these again are my targets, more technically based of what we're looking for. I'd say from a fundamental base, we've got quite a few things that I'm looking for. So on Tuesday, we've got the Bank of England speech. So we're looking for something from Mark Carney. Maybe he'll give us some forward guidance. Maybe he won't. To be honest, Mark Carney's been a bit of a disappointment. He had a real opportunity to shake up the establishment, to kind of bring us into the 21st century properly, and he hasn't. He's stuck to the old guard and been very guarded, and it's been pretty disappointing. But then on Thursday, we've got a real opportunity to see if these growth/inflation figures are more in vogue, because we've got the US retail sales. Now remember, there's a bit of a time change in the minute, so the times are not always set in stone. Right now, we've got some 12:30 and some 1:30 figures, but we've got retail sales from the US on Thursday at 12:30, and that for me is a big enough figure to tell me if we're not concentrating on the growth figures anymore and we're actually concentrating on the inflation figures. And if we are, and we see a big movement around the retail sales, then we're really going to know that inflation figures are what we should be focusing on now. Then on Tuesday the 17th, we've got the Bank of Japan press conference. Bank of Japan, Bank of China cutting the rates. These things I don't know, these things that are fairly worrying when you talk about the amount of dollars, the amount of currency these guys hold. So that is on late at night, but there might be a follow-through of that when you get up Tuesday morning. Then after that, we've got the ZEW at 10 o'clock on Tuesday the 17th. Now, Germany's still in a precarious position, let's not face it. The Eurozone, with Greece, the last minute, we're playing this giant game of chicken, weren't we? Is Greece going to give in? Is the Eurozone going to give in? Oh, Eurozone are playing hardball. Oh, Greece have come back with a curveball. Fact of the matter is, Greece are just buying time. The European Union are buying time. If Greece don't leave the European Union, I'll be astounded. If the Euro survives another year, I'll be astounded. Okay, we've come too far. We borrowed too much. It's going to end. Okay, it's just a matter of time. Okay, and that might be a year, might be 18 months, might be 2 years, might be 5 years. As I say, I don't know. I don't really like tying myself down to timely predictions because I'm only human. I can't give you everything. I don't know everything. I just have a good idea of how the world works, how people work, and how the markets can trade technically. So I'll have a look at the ZEW because any worries in the ZEW could really kind of put some added pressure on these negotiations and talks with Greece. Remember, on a third bailout, Greece has a 25% lower GDP than it did do, 2 years ago, and it has 3.5 times, the unemployment rate. They are a staggeringly terrible set of figures. How is that going to get sorted? I don't know. It isn't going to get sorted by throwing money at it. So bailouts for me are really just treading water. So after that, we've got on Wednesday the 18th another one from the UK, which might be interesting. We've got the rate hike announcement. So we've got 0 out of 9 saying for a cut, 0 out of 9 saying for a hike, 9 out of 9 saying unchanged. But if that figure is changed in the slightest, then again we go back to that pound versus the dollar, go back to cable. And if we do see a clue that the markets, maybe thinking that the UK will keep up with the Fed with their rate hikes, then we might see some of that 7 months of selling come back. But as I see it right now, if the Fed are going to move first, then we're going to just see nothing but dollar strength and pound weakness. But again, it's down to your call to see how you make money out of that. The following Thursday the 19th, we've got the Euro LTRO. So that's previously 1.2984 billion. So this is the amount of, money the European Union is pumping into the economy. So that should be interesting, just to see that the numbers stack up, the numbers keep the same. I don't really know where the Eurozone are getting this money from. I don't really know how they can back it up, but they are. So anything, that kind of really puts a wobble on that, then we're going to see further Euro weakness. I'll go through the Euro in a little minute because, again, I've been saying sell every high in the Euro for as long as I can remember, but we're getting some tricky times now where if you don't start selling high enough, you're not really going to be able to make any money, or any intraday money, I should say. So Tuesday the 24th, again, we've got the CPI. So again, CPI, PPI, retail sales are all inflationary figures, okay? So the CPI and PPI, if I'm indeed right, and the Fed are going to be playing more into the interest rate category, then we're going to have to look at what the CPI and PPI are. So strange figures, minus 0.1 expected in the CPI. So it's difficult to see what excuse me, what has changed in the market over the last month. But again, we're not looking for the change in the figures per se. What we're looking for is a change in how the market reacts. And if the market reacts in a more aggressive way to these figures, then we know the real traders, the institutions, the central banks are all going to be focusing on the inflation figures rather than growth. And then that's what we ourselves should be focusing on. Not to say the non-farm payroll, as I said, won't be important, or the other key growth figures won't be important, but we'll get into that cycle where it'll be nothing but listening out for the Fed, the Bank of England, ECB, all to do with will they, won't they on interest rates. Then Friday the 27th, we've got the GDP Q4 expected at 5%, which is quite high, so that should be interesting. And April the 1st, we've got the ISM non-manufacturing. Then we're back a full circle, back to the non-farm payrolls. So what I'm trying to do with these sessions, again, these are fairly new kind of sessions. I'm trying to give you an idea of what we should be looking at. Again, I mean, S&P 500, a great level to buy here. This morning I bought some low at 2067. Again, just chipping away. So I didn't, kind of ride the trade out. Just got some profit out here, digging away back at that loss. But the DAX hasn't finished making new highs yet, and as I said, the FTSE is definitely going to get to 7,000. So all in all, if gold does remain weak, then the indices should go on to make new highs. They've got no main reason to sell off. This was just, again, big profit taking at the top. But if it starts to get back to these upper levels, then people are still going to buy new highs. I mean, why wouldn't they? Okay, we haven't seen a major correction yet. You look at the hourly chart, you think, oh my God, that's a terrible chart. And then you look at the dailies, it's nothing. It's absolutely fine. Look at this range up here. Yeah, we've taken some profit at the top. What happened when we took profit at the top before? Went on to make new highs. Profit at the top. Go on, okay, not new highs, but then made significant highs, but then make significant lows, then new highs. So just keep going back into the charts to tell you what it's done. When we've hit low points, yeah, and sold off quickly, we've gone on to go higher. Yeah, so it's just fundamentally finished right now. I very much doubt it, but it could be. But if it's not, keep buying them lows. Yeah, we're in a massive bull market, and the only way we need to know that is look at that monthly. Look at that monthly. You're trying to tell me, look at that trend line. It's practically straight. If the market was going to sell off by now, it'd have done it here. We'd be ranging and gone lower, but we haven't. Every time we've seen an attempt to close lower, we've gone on and made new highs. So we're by any stretch of the imagination finished with this bull run. And again, big profit taken at the top on a 293 non-farm payroll figure. Great. Well, I'm sorry, I've only got 11 grand in my account, okay? I trade a very modest account. I don't have 11 billion. So I've got 11 billion, I could sell that all day long on Friday, push it down as long as I want, and then by this time, a week later, it'll be making new highs. And I've made, my billions of profit. I don't have that account, so I can't do that. But that's how the other people in the markets work. But if you're trying to tell me that uptrend is over, yeah, on the back of a better than expected non-farm payroll, no. And again, don't be fooled into thinking that interest rate hikes are a bad thing now. We've had 7 years of artificially low interest rates. We've got a lot of rich people in America that need their savings to be paying them back. We need a normalized economy. So if the US think that the economy is strong enough to survive an interest rate hike, then, that's a good thing. It's good news. Having a normalized economy is good. Pumping billions of dollars, trillions of dollars of QE is bad. So we've stopped that. So actually, that's another reason why we're seeing dollar strength, is because they seem to have their act sorted out. Europe, not too sure what's going to happen with Europe. Nothing good, is what I suspect. The UK I had a lot more faith in, but they're acting like, little spoiled babies trying to win this election. They're not thinking of the good of the people. And you tell me, do you want to live in a world where people can't aspire to get on the property ladder, can't afford to, have to go to food banks, can't afford to send their kids to school? Is that the UK you want to live in? Not the UK I want to live in. Not that I live in the UK. I'll give you that. But it's not the UK I'd move back to. What's the point? You can't have this massive gap between rich and the poor, because history tells us something bad happens. So you can have all the money you want, your nice flashy car and your house, but then if you have, a big crime spree and people just disregard the law, all these things could happen. Then what are you going to do? Yeah, nobody's going to want that. We all have to live on the same planet. We all have to live in the same country. And, again, these are very high-level ideas. But these are how, big revolutions start. These are how things happen. Major world events. If you keep keeping people down and don't let them aspire to the things that the world's promised them, then they get disillusioned. So as I would say, this monthly spike in the S&P and the downtrend that we've seen, I don't think that's going to be long-lived. While the indices remain so strong, you're getting, again, Apple being the first trillion-dollar company, perhaps. Where would you put your money? If you're a rich 1%er, where would you put your cash? Greek debt or Google shares? The reason why the indices are so buoyant is they're a liquid way to put your money, and they're giving, pretty big dividends and good returns. That's why the indices are going to remain high. So I'd say really, again, I'd just jump back on that that buying pattern of the S&P and just keep riding it. Just keep riding them waves, to be honest. Yeah, every low point that you see significant value, buy it. The same with the DAX. Probably not the DAX so much, to be honest, because the DAX is a lunatic. But what you don't do is sell every high in the DAX, because the DAX will just destroy you. So again, maybe stay away from the DAX, but buy some value in the FTSE, because I'm pretty sure it's going to get 7,000. And then the S&P, again, just buy oversold areas and get involved. Okay, so we've kind of covered the main kind of trading targets that I've got, the higher level stuff. So the 7,000 in the FTSE, the 11,000, the 1,000 in gold. Kind of the euro dollar. Sorry, I didn't go through the euro dollar, but again, I'll just go through the euro dollar. I mean, It breaks my heart sometimes, because I was talking, at these levels where we're going to break. You can just draw it on. It's absolutely kind of, not set in stone, but I mean, from a technical perspective, it's very easy to see where the markets will be pushed and when they do break, what's going to happen. So that green line that I drew, funnily enough, see that green line? It's absolutely spot on the 50% of the up move. Now, I'm not some David Blaine magician, but you can't see that as being coincidence, that significant low, a significant point of interest in the market for support and resistance previously, is the 50% retracement of this up move here. So once we broke below 123062, we're going to test these lower levels, and we hit 1.14, then we broke it, we came back up to test it, and we're coming back down. So where does it go now? Unfortunately, you have to go back to different means, your big round numbers. So there we go, 1,100, broke it. Well, now what, Steve? I don't know. I've kind of sorry that the pretty much the 3,000 ticks I predicted, wasn't enough. For where we're going to go now, it's down to these absolute, key levels. Parity, 1.0, and that was probably unthinkable up here. But all of a sudden. But, we're going to see a bounce at some point. We've seen 1, 2, 3, 4, 5, 6, 7, 8. There's been 9 months of euro selling. So there has to be some value at some point. I don't really know if we've got enough strength in this monthly candle to get down to this this parity level before we see at least some green profit taking. But stranger things have happened. I mean, again, look on your weeklies. See how these things build up. I mean, lots and lots of red candles. Then we have to see some green. Yeah, more red candles. Have to see some green though. Red, have to see some green, but weekly, not quite so good. We might see big sell-offs on the weekly before we see that green. And once we do see that green, you need to go back to the monthly and try and ride it for a long-term trade if you want to make some serious money. Because again, you don't really ever see 8 months of sustained selling on a monthly chart. You just don't. But as you move through to the dailies, again, you're building up a picture that every time this market looks weak, it easily gaps and goes down, and then we find, I mean, look at that. It's a beautiful line, of support resistance. Beautiful. This is why I love charting. I love charting because, you can see once we start to reject that line, 1, 2, 3, 4, 5. You have to wait and be patient, but then you get your rewards, and it goes to your next level. Okay? So realistically, looking for this 1,100 to be resistance. If the market looks weak, we're all the way down to parity. So you want to trade it here, stick your stop here, 500 ticks to make 800 ticks. Simple as that. That's your long-term trade. Because that's the one or two things that are going to happen. Or be a little bit more savvy and sell here, maybe average into this range here, and then let it come down. As I say, it's difficult to say, but what I would say is the long-term trend for the euro is very negative. Both the fundamentals and the technicals, for me, look absolutely shocking. The unemployment rates, especially for the young, the people who are going to be coming through and you're meant to be, driving the economy. We're an aging economy, an aging population. We need to be driving the young people through, getting the good jobs and paying taxes, but that isn't happening. So, Portugal, Spain, Greece, even Italy to some respects, terrible unemployment data, terrible. And we're too far down the road now for these things just to be, magically, made better by public policy, government policy, or by QE or any kind of real public spending, because the money isn't there. So really, it's down to the private sectors. And unfortunately, having lived in Spain for so long, Spain doesn't really have that much industry. So it's if we don't go back to their own currency and get people back, spending for tourism, then it's all finished. You're not going to go and spend €8 on a panini and a beer in Benidorm if you can go to somewhere cheaper, that's got their own currency and get it for a quarter of the price. You go to Croatia and get things for next to nothing, £1 for a beer, or Bulgaria, something like 70p for a beer. You're not going to go to Spain, are you, and pay over the odds. So again, just looking back to that euro, the trend is set, and as I've said, we're below Fibonacci levels now. So we're looking for resistance back at 1.100 and buy it back at 1,000 dead. 1.000. I mean that looks to me where it's going to go. All Alright guys, I mean obviously these are my trading targets, so I've gone through the fundamentals, I've gone through the technicals, I've gone through what I look for as a professional trader, and is there anything that you guys would want to ask? So I'll just read back through some of these comments. Thomas was saying that predicts gold at year end to be 1170, absolutely. Ian's just saying continue to average as well, but was wondering if he was doing the wrong thing. No, Ian. I mean, again, if you averaged enough down the bottom and you got the bounce, then you would have got out for less of a loss, maybe a scratch or a win. I don't know where you got out. You don't have to tell us, but if you averaged in at the right place and waited for that green candle, then you're right. But I liquidated my entire position. I didn't hold it overnight. I wasn't greedy. I got out for the loss that I was willing to take. Okay, Edward's saying, I'm using the Trading Central to base placing trades, presuming that's reliable. Well, it's as reliable as anything, Edward. I mean, again, technical analysis is technical analysis. I mean, I would say that you have to build up your own 80-20 rule, that of what the markets are going to do 80% of the time, what the technical levels that matter, and that's what I've gone through today in all the different markets. But they're my own technical analysis. I don't rely on anybody. And then the 20% of fundamentals is the view, will they, won't they, move first on interest rates in the US, and for the currencies especially, what's going to be the strongest currency, and it looks like the dollar for me. That's what I'm basing my decisions on. Yes, good advice there from Ian. Okay, yeah, about contacting InterTrader. Yeah, the support's very, very good. Rambling Rose, plenty of food for thought. Well, that's again, here to throw some ideas down, guys. Please, do fire back any ideas of your own. This is not, me preaching. I'm just telling you how I kind of, get involved in the markets from a technical and fundamental perspective, and how I come up with my ideas and the reasons behind them. The reason why I can stick to my trades and I can stick to my guns, and the reason why I get quoted in the Wall Street Journal, Bloomberg, Reuters, it's not because I'm all from InterTrader. I'm not from a big trading house, am I? I'm just from InterTrader. So they come back to me time and time again because I'm personal. Okay, I make these things personal. I trade them. I make money with them. I don't just say, "Oh, Steve Ruffley's clever, pat on the back because gold got to $1,000." I sell every high in gold. I'm living and breathing these things, and that's why you get a different level of education and you get a different experience. I don't know anybody else that's traded the markets for not just the length of time that I've done live in front of people, but also traded the markets through different conditions, mentored some of the biggest some of the biggest traders there are, and I've risk managed 118 traders at one point. I had 18 screens watching 118 P&Ls. There's not many people that have seen these many different aspects to trading and seen people get it spectacularly wrong, and people making £1 million in a minute. I've seen it all. I've literally seen it all. And what I'm trying to do is just open your eyes to that we don't want to get too insular on a spread betting platform. We want to just get in and get out for what we can achieve, what we think's fair. We're not here to try and make, millions of pounds a day. We're trying to get in the market, get out the market, bank that profit, and repeat. That's what all my education's about, intraday making money. And as I said, you can watch my account. It's all there on my blogs on the internet. £7,000 over the last 6 weeks. I've had some big hits. I've taken a big hit in the DAX. Taking a big hit on the non-farm payroll. But I will just claw it back by all the means I tell you, by trading smaller, being patient, waiting for the good economic data, get your confidence back. Not that I need that, but then, start to trade and then build your account up. If you ever look at a graph for any kind of trader's account, it goes up, it takes a dip, it goes up, it takes a dip, it goes up, or it just goes down to nothing. Yeah? I'm never a down to nothing. Up, dip, and that's the only way I know how to trade. That if I don't take the risk, I'm not going to make the money, and if I take the risk, I invariably will lose now and again. That is trading. But I don't lose as much as I make, and I'm still in the game. So what are the rules for direction of drawing fibs? Okay, well, that's a very good question, James. Let's just do a quick idea on fibs. Let's bring something that I never trade. New Zealand dollar, Japanese yen. Okay. So the rules for drawing fibs is you're looking for a point of interest, okay? So you're looking for something interesting that happened in the market, and that'll be either something like this, which is a strong directional move, or something that looks out of the ordinary. So if you're trying to get your bigger ideas of fibs, then what you're looking to do is go from a significant low to a significant high. So if you were saying that I think, although the bull market started against the Japanese yen and the New Zealand dollar here, I think really this is where we really could have come down, okay, and broke back into the range. So I think that this is where the continuation of most recent up move happened. So I'd say I want to know if there's still more bulls than bears in this. So you go to here and you see how it's reacting around that 50%. Okay, so we didn't get anywhere near the 50%, didn't get anywhere near the 38.2. We've held over the 23.6. So that tells me that in this area here that we've gone from, there's more buyers than sellers. So that's more likely if you look at the difference in the size. There's more people long than there are short. If we keep holding above these levels here, then we're going to test this high here and go on to make a new high. So I'll be looking to buy low points in the New Zealand dollar to break this high and then take the market, I don't know, take it back up here at these previous highs. So you've got a potential, I would say, from this point here of another 91 ticks up and maybe 123 ticks down from that point. Okay, so not a great risk reward if you want to hold it, but I'd say as long as we hold above this key level here, the rejections have told me that the market's buying up. Okay, or similarly, if you want to do it on an intraday chart, you do it on a significant point of interest. Okay, so a significant point of interest for me was when the market was going up. Might tie in with the non-farm payroll here. So do your Fibonacci on that candle here. And if that doesn't get back to the 50%, which it doesn't get back to the 61.8, then we're still bearish. Okay, so we want to say that if we don't get back to the 100%, then the market's going to break the 161.8 and get to the 261.8. So I'd say from where we're trading right now, that we've got 27 ticks to make 18 to make a break of 90. So you put your stop above here, so you'd risk 27 ticks. Yeah, a breakout point 18 ticks away to make 96 ticks. So 4-to-1, 5-to-1 trade there. There we go. That's Fibonacci. Look for a significant point of interest or a strong directional move. Look for that pivot around the 50%. Now, that's my interpretation of Fibonacci, but that's what's made me a lot of money over the years. No problem. Apple in the Dow. Yeah, I mean, I think, Roger, the problem with Apple is that Apple's out on its own, isn't it? It should almost be its own stock market. It's so heavily traded, it's so heavily invested in within the institutions that we don't really know where to put it. So unfortunately, it's a tech company, so it has to stick aside of the stocks. But to be honest, I think all this talk with Apple being the first $1 trillion market cap company is pretty likely. And you know, with the Apple Watch coming out, with 80% of people in the civilized world will have a mobile phone connected to the internet in the next 5 years. So what do you think that does for Apple's sales? Nothing bad. So realistically, Apple, need to be out on their own, don't they? They need to be their own listing, their own stock market, I would say, because they're just too big. They're too big, really. But I don't know. I stay away from Apple as much as I can, to be honest, because I don't really trade individual shares, and I would say that all the money kind of intraday, or all the money kind of that the retail trader could make has been made in Apple. I just see more value everywhere apart from Apple. I just see me getting an absolute spanking if I try and buy some Apple shares, so I'm going to stay away. Can you customize MT4 fibs so you get the expansions above if you want? Okay, Ian, well, there's two ways of doing the fibs, as always. If you want to get the expansions, then you draw the fibs in the opposite direction. So if I want this market here to see the Fibonacci expansions on the way down, then just draw it from the opposite direction. So it's a red candle, so the low to the high. If I want to do it up, I do it from the high to the low. Or you can do anything. You can set the Fibonacci's to draw what you want, but then you just do insert Fibonacci expansion, and you can do an expansion of anything you want. So you draw your own expansions and then tie in a Fibonacci retracement. So you can look for the retracement and then do, and you can do pretty much anything you want with MT4. But I mean, again, you might have to get a programmer to do it though. So everything I do has been programmed by professionals. How do we do this again? Indicator, objects, Fibonacci. Yeah, I mean, you can go in and you can, add Fibonacci levels and take them out. So you find it in the objects list and you just edit it, and you can put your own parameters in and change these around. So Make that 200. So you can do that. I really wouldn't recommend messing around too much with the Fibonacci's in, to be honest. If you want to do anything, kind of crazy like that, I would get involved with some programmers that can. Fibonacci retracements are very, very easy. If you go on the MT4, MT5 forum, you could probably get that coded up however you want for $50. Okay, so you can get whatever levels of a Fibonacci you want, and you can just get a little bump up here. It costs you $50, $60. Send me an email, Ian. I'll try and sort it out for you. sroughly@tradermaker.com. Let me ask some programmers, see if they can get it done. All right, guys. Well, listen, that's pretty much, I would say, a good roundup session of, a technical and fundamental perspective of what's happening in the next kind of 3.5 weeks until the next non-farm payroll. I would say again, really for me, I'm looking for that weakness in gold. You see, every time we try and push higher, you want to sell it high, ready for the breakdown. I don't think the indices, by any stretch of the imagination, are finish selling off longer term, but shorter term, there's a lot of value down the bottom, isn't there? Euro is going to continue to get smashed because it's run by Mario Draghi, who's an idiot. And I would say that really, you'll look at that interest rate decision between the Fed. It's going to be interesting. We'll see what the Bank of England say on Wednesday. Okay, Wednesday the 18th. That gives us a clue. There's going to be a rebound in the pound versus the dollar, or we're going to see that continued strength in the dollar and further weakness in the pound. All right, guys. Anything final? Any final thoughts? Any final questions? Yeah. Well, I mean, again, if you do like these sessions, guys, again, I'm just doing 3 test sessions of these. So if you don't like it and you don't give me some kind of good feedback, or you don't want to, send InterTrader an email, send how good they are and that kind of stuff, I'll stop them, because these are quite intense sessions. I'm going to send out a supporting email to everybody with all my ideas for the month, etc., etc. So if they're not good and people don't want to see them, then if I don't get the support and the feedback, then InterTrader won't carry them on, and I won't carry them on. So again, we need to know that you guys are enjoying these things and you do find them useful. So a little email, a little tweet, anything to InterTrader will certainly help me. And again, I do these things for you guys. I don't necessarily kind of have to put as much effort into the webinars these days as I did, but again, I said if I didn't enjoy them, I didn't think, I brought something to the table, then, I wouldn't do them. I wouldn't do them as much. Well, listen, guys, good luck with your trading. You know where I am. Get me on Twitter @SteveRuffley. Anything else that you'd like, just get in contact with me. And any feedback you can send to me or other InterTrader, positive or negative, just let me know. I'll take it on the chin. All right, guys, well, listen, have a great afternoon, and I'll speak to you all very soon. Take it easy.